Robert, build on that for me, please. Why, when many people expect some steepening to come through the curve, you expect a flatter one in the months to come?
Yeah, I mean, what's happened here is that there's been a creeping value in the back end of the curve. The front end of the curve, you know, the one-year point on OIS, what people expect the Fed to do in a year is looking at negative rates. Meanwhile, at the back end of the curve, your 15-year, you know, very distant Treasury rates are pushing in over 2%. So you have a huge slope in that curve. And, you know, right now we've just come through a big rally. I mean, the 10-year note a few weeks back was pushing 1%. Now we're down at 69 basis points. I think that kind of 60 to 80, 60 to 100 basis point range is probably going to define what we're going to see for the 10-year as we go through this good news, bad news on the economy.
So where does the flattening actually come from then, if you're still looking for a range of 60 to 80 basis points, Robert?
Yeah, I think it's going to come to some extent from the back end, and it's going to be a range trading environment. I think that, you know, the big surprise here is going to be that when you fast forward 12 months, maybe 24 months down the road, you're going to have very favorable returns from fixed income. I think it's going to come largely from some bull flattening in the curve as people realize that there's going to be years of Fed on hold, and that's not exactly what's priced in. And that your credit markets are going to continue to perform well. I mean, valuations have moved ahead of fundamentals, but that's how markets are. They're going to stay ahead of the fundamentals. It's going to be a very bouncy ride. I mean, I think this ADP number this morning just goes to show how much uncertainty they're dealing with when you see those kinds of revisions in the number. But in the end, we have a recovery going on here, a lot of stimulus, and corporations that really want to survive. And so I think that that's going to be the surprise here, is that these forward rates at the back end of the curve are too high. You're going to get outperformance from fixed income over the intermediate to long term here, and it's going to be a good diversifier in portfolios.
But Robert, this is what so many people struggle with right now. You're looking for anemic growth. You're looking for low rates. You're looking for the long end to continue to outperform, to do well in this environment, yet you still think credit spreads can grind tighter. And it's that second part of your overall view in the fixed income market that people struggle to reconcile. How could Robert Tipp have such a low conservative view of the economy and have this bullish view on treasuries, but still have this constructive view on credit? What is that all about, Robert?
Right. Well, sure. Well, take a look at the liquidity environment. I mean, this is one where a spectacular amount of cash is on the sidelines in money funds. And investors, despite the recovery in risk assets, are not offsides hanging out in risk assets. And so what you see is a real swarm. Whenever you get some attractive issuer coming to market, there's plenty of money to go sop them up. And so, you know, the mix of a lot of money that's willing to take these corporations to the other side, and the corporations are also primarily focused on getting to the other side. So we're not in an environment where the corporate management is looking to take the money and go do a buyback or a dividend. You know, they're one where they're looking to maintain credit quality to make sure they get to the other side. So that creates a certain alignment. Now, it's different for every sector, you know, whether we're talking about emerging market, hard currency, or local, or high yield, IG, structured product. Each area has its nuances, and you have to be extremely careful because there are going to be problems. There are going to be defaults. There are going to be extensions, you know, of mortgages and so on. But for select investors that are able to, you know, avoid the potholes out there, there's a lot of spread still left on a lot of paper, and that's going to fall to the bottom line over the next 12 to 24 months.